Hey guys, it's Willie. Today I want to take a look at Viatris. At least I think that's how you pronounce that name. They are a global generic and specialty pharmaceuticals company. They're part of Pfizer. They've merged and done some stuff with a offshoot of Verizon. Pfizer, not Verizon. They're not a telephone company. They're pharmaceuticals. Pfizer. Sorry. Right now they're trading at $10.02. There's a 6-month chart. As you can see, it's down 28%. Not looking too great. However, a lot of that has happened since, February of 2022. Really, the end of February 2022. You're seeing a 31% decline since then. And I'm always interested in stocks where you see this giant drop-off. Because a lot of times that's because of, one bad year of earnings, one bad year of revenue, one bad quarter, or some bad news or something comes out, which will affect the business in the short term. However, as long-term investors, we don't really care about short-term information. We're looking for long-term trends and things like that. So looking at these sorts of companies, they can really be used, at least these big drop-offs can be used to identify possible buying opportunities. This is not something where you see a stock do this and you immediately buy in. No, do your due diligence. But yeah, I think this one, it may be interesting, just looking off the chart. So let's flip over to the spreadsheet here. Stocks ticker symbol VTRS, if you guys are interested. Again, $10.02. Revenue growth, you're looking at pretty good revenue growth. I would assume that there was an acquisition made maybe here or here, possibly, to bring revenue up so quickly. As you can see, you've seen, 11 billion, 12 billion, not a lot of growth right in here, pretty much flat, especially from 2017 to 2020. You're right, you are flat. Net income, not that great. You're seeing okay numbers in the past, and then from 2018 you saw a drop, and then it's been falling down since then. Not really that good. Free cash flow. Again, you're seeing a big jump up to here, flattening out some, and then dropping off. Not a great sign. Hopefully this is short term, and that's something you would look into in your further research, reading reports and articles and things like that. Shares are going up. We don't want shares to go up because that dilutes us as shareholders and forces us to own a smaller percentage of the business. So we don't like that. Earnings per share, you're seeing the same sort of situation with the net income and free cash flow. Good years, and then here recently you've seen a falling off. Assets really jumped in the past year. I don't really know why. Again, that's something for you to figure out in your due diligence. Your dividend, they have recently started paying a dividend in 2021, which I don't entirely understand why they've decided to, because your net income is coming down. Your net income is negative. Your free cash flow is coming down. Your shares are going up. I don't see why you would start paying a dividend now. Over the past year, but over the past 10 years, they haven't paid a dividend. I think the last dividend they paid, with exception to the recent ones, was 2007, I think. Don't quote me on that one. Don't quote me on anything, frankly. Total debt, you've seen debt go up. So I think this might be part of the whole assets and debt thing jumping. Your cash, is that a jump? I mean, it doubled. I guess it is a jump. I'll count it as a jump. So your net debt, you're looking at that, 37 billion. Your ROIC has been good, which we would expect from a pharmaceutical company, but then you've seen some pretty poor years here recently. Don't really know why. Again, that's something to figure out beyond the screening process and your due diligence. Our metrics, our PE, it is technically less than 20, but it's a negative number because our net income is negative. And I don't like businesses that don't make money. Why would I invest in a business to make money if the business doesn't make money? That's just stupid. 5-year PE, That's high. Your price to free cash flows are low. They are very low based on your free cash flow, which I think is a relatively accurate assessment of the business. That's the word I was looking for. Your net debt's high compared to free cash flow, really high. Yeah, that's a really worrying number. 23 times the average 5-year free cash flow. Really big. See if you're comfortable with that. I personally am not comfortable with that. That just seems way too high. Moving on, revenue growth, positive. Earnings growth, error. Free cash flow growth, negative. Shares going up, bad. ROIC, average of 3% over the past 5 years. That's, guys, come on. You're a pharmaceutical company. You're supposed to do better than this. Okay, on to our forecasting. We take our free cash flow. I'm going to grow it at 1% a year. Because, I mean, frankly, you've seen, this huge drop-off. I'm not going to assume anything huge happens in this company. I mean, I want to make conservative assumptions. Net income, your negative number is getting bigger over time. I hope that it wouldn't get bigger over time, so I'm going to bring that back down to 0. I'm going to assume that they keep a negative net income per share, which I hope they don't. I really, really hope they don't. I've assigned a PE of 15, which is the market average. You get price to free cash flow, price in 10 years of $27. Your net income number is negative because it's negative. And so when you average those two, you're out at $5.30 in 10 years. So you buy it $10, you get these free cash flows, you're out at $5.30. That's a 19% return. So you're seeing a really strong return number with this. But the problem with this company is that there is inconsistent growth. That's why I made conservative assumptions. You're going to want to go in, do your research, and figure out what you really think those numbers are going to look like in 10 years. You're going to want to figure out, the shares outstanding number. It could kill you as an investor. The debt. God, the debt. Figure out the debt. If you're comfortable with the debt, go for it. I'm not. 23 times free cash flow? I mean, guys, come on. It's going to take them 23 years to pay off their debt if they were to throw all of their free cash flow at it. It would take them more than 23 years of taking all of their free cash flow and paying it to their debt. And they're using some of it as a dividend. I don't understand why this company would do this. But I think you're looking at a cheap company that if you think it can maintain this level of free cash flow is cheap enough to give you this sort of 19% return at the current price. But guys, I would avoid this personally. As always, I'm not giving any sort of financial recommendation for anybody to do anything. But yeah, the debt number is just way too high for me. The stable numbers aren't there. I just don't understand why this business jumps around so much. Why it's so inconsistent. I can't make a solid forecast on it. As far as a screening process. If you want to dig down into it and you think that this company's going to be in a better situation than it is now, I think it's a buy. If not, then yeah, I'm out. I'm completely out on this one. So, to wrap up the video, do your due diligence, like, comment, subscribe, all that stuff. Comment below if you want to see, if you have any stocks that you'd like me to look at, or any comments on the video, anything I can do to make this better, make it smoother, anything I can do to make things better. I listen to constructive criticism. Anything else I want to say? This is not financial advice. Disclaimer. Yeah, that would be good to say. But beyond that, I think I'm done. I'm done rambling for now. So I will end the video here, and I will catch you guys in the next one.